So one thing that's clear from earlier in the afternoon, there's a lot of great strategies, a lot of great approaches. Everybody's got a different view of the world as to what may work, what may not. And I think one thing that is clear from really what everybody said is we are moving into a world that is quite different than the one that we've been in. And maybe some of the rules that people have learned along the way may be challenged a little bit. Some of the correlations are different, and what may work going forward might be somewhat different. Barometer is a firm that runs money for families, foundations, some family offices, and we have a basic underlying view that at the end of the day, money is always in motion. And capital finds its way to the place where it's treated the best. And from time to time, there are structural shifts that take place that benefit one asset class or another, and that can go on for a long time. Revaluation is where you make money. So whether you're looking at equities over a long period of time, or there have been several structural long-term revaluations where multiples expanded for a long period of time, until ultimately they were overpriced and overowned, and then went through many years of underperformance while money moved to other places, like say commodities or fixed income assets. So at the end of the day, I think we all have clients who pay us to find our way to the place where we have a tailwind. We are directional. We are trying to identify those structural shifts, both positive and negative, and build portfolios that are relevant to the current environment that we're in. If you boil it down, I think our clients expect us to have a broad mandate because what works changes, but have tools to identify what's relevant right now. I'll call that leadership. That can take all kinds of different forms. We have to recognize structural shifts to reposition portfolios in a timely way. And there's times when correlations go to one, where maybe we need to step aside from time to time. So really what we sell is a very tactical strategy. It is directional, and ultimately the goal is to build a portfolio that's relevant to the current climate. Now, baseline to what we do, 80% of return comes from getting to the right neighborhood, getting the asset class benefiting, or be short the one that's being hurt, and then find the groups within those areas that benefit and those that get hurt and build a portfolio that's relevant. So we've got two sets of tools we focus on. One is aimed at finding securities to express a view that meet some pretty strict criteria, but more importantly, we have a set of tools that help us understand the current market environment, say where is it that money's getting put to work, where is money leaving, how can we take advantage of that? So just by way of history, we started our firm in 1991. We've been at it now 27 years, I guess if you do the math. We started with an equity strategy, trying to find revaluation themes in equities. The 1990s was a great time for that. We've run an equity strategy up till now, top-down driven. In 2000, our view was equity returns were going to be challenged going forward for developed markets. We started a tactical income strategy, which fortunately did quite well. Common characteristic, both had roughly 50% correlations to their benchmarks and roughly 50% of the risk of their underlying benchmark, with a little excess return. 2008-9 comes along, and obviously a very difficult period for lots of people. Our income strategy, I think, was down 7, our equity strategy down 14. We felt we did pretty well. Clients told us how much money we lost. When we did a little bit of navel gazing, we found that the one category of asset management that made money really across the board was global macro. People expressing their views in large structural themes, being able to take advantage of those negative things that hurt so many people. And so we set out to build a strategy. Global macro is, I think, the biggest category of hedge today. It's close to $1 trillion in size for obvious reasons, at roughly half the risk of equities over the last 20 years, with a roughly 40% correlation to the group, low correlations to bonds, to commodities, to fixed income. It is a diversifier. The place in the portfolio is, this is a rover, this is the strategy that can go anywhere. It's an all-weather strategy. The problem, I think, in general, is that for Canadian investors anyway, they tend to be fairly opaque, tends to be lots of leverage, and ultimately a lot of derivatives. And some people are comfortable with that, some people are not. We chose to build a mandate using ETFs as the vehicle, fairly limited leverage, 30 to 50 positions, go to any place in the globe, in any asset class with a systematic approach. And it's worked pretty well over the various periods since inception, 7 years, 5 years, 3 years, sort of top quartile against the global macro universe of managers, with pretty good risk-reward characteristics, strong in each of the 5 best 3-month periods since inception versus all world and S&P, and a little bit less risk in the down periods, low correlations across the board. So this is a strategy that is a diversifier. Basically, all of the strategies we run employ a top-down model that tries to identify pockets of the market that are seeing net new investment dollars getting put to work. And then we build portfolios, in this case, using ETFs and use stops on all of the positions. The baseline belief is that over time, money goes to the place where it's treated the best. When you head through a decline, the weakest assets sell off first, and by late in the decline, most things are being hurt. When the most aggressive folks put money to work, the strongest securities turn up first, often before a benchmark does. And as you go through an advancing market, breadth in a healthy asset should be expanding. More and more securities participating. There's no bear market in history in any asset class that took place while breadth was expanding. Similarly, there's no bear market in history that ever took place before days or weeks or months of deteriorating breadth before you saw it in the underlying benchmark. So breadth leads price. We run breadth-based models that quantitatively looks at about 300 universes of securities to try to identify where money is being put to work, what has a structural tailwind, what is it that has a structural headwind. Where we see headwinds, we can be short. Where we've owned the securities, we'll use our stops, we'll raise some cash, and we'll step aside. This is something that we run against lots of different universes that we could focus in. I'll give you an example of a trade. After the 2008-9 debacle, the first equity sector that turned higher in our work was the energy space. Of course, fracking was changing the world. Energy production in the US exploded for the next 5 years, and the sector was completely revalued. You know, if you took the pipeline space, it went from 6 times earnings to 24 times earnings over 5 years. And as it happens in a revaluation, structurally looked expensive the entire way along because relative to recent history, multiples were extended. At $140 a barrel, breadth in the energy space, let's see if I've got it. Do we have a pointer in here? No. Breadth in the energy space started to collapse in July of 2014. In our world, what that means is, A, if we own it, we gotta be gone. Second, if we don't own it, it may be something to be short. We built short positions in producers and service companies, just using simple ETFs. It was a 1-year trade until ultimately breadth turned higher in January of 2016, giving not only a cover, but an opportunity to go long. Now that didn't happen in a vacuum. That happened against the backdrop of a correction that went on globally from 2014 through early 16. I think China was down close to 50%. That was the epicenter of the problem. The things tied to China, like the resource producing countries and the heavy equipment exporters, were hurt 25 to 35%. The US was probably the best, not getting hit until the end of 2015, down 15%. Of course, nobody wants to live through that. If you're long only, you're stuck. Maybe you can go to cash, maybe you can step aside. In a macro strategy, we were able to take advantage of short EM, short commodities, short China, and ultimately hedge up and have an opportunity to make sort of 25 to 30% over that period of time. So this is a strategy that has no handcuffs. Now, interestingly, coming out of that, in 2016, breadth for equity markets in the US turned higher in the second week of February, and it led to that 2 years that people say really made no sense, low vol for an extended period of time. Interestingly, much similar to the rally that came off the lows in 1984 at the beginning of that structural bull market, or the rally that came off the lows in 1953, 2 years actually in each of those cases of lower vol than what we saw coming into January this year. In each case, the third year was excellent, but there was volatility. And in the early part of February this year, breadth in equity markets around the world rolled over and went through pretty good sized correction, a little over 11% in the S&P, but ultimately a bull market correction. Breadths turned higher in all of the major indices, really around the world. We held that 200-day moving average a number of times, giving opportunity to set up long positions on the other side. So we publish our allocations transparently every week. What is it that we own? Our big weighting over the last few years have been US equities. European breadth is improving, Asian breadth is improving, Japanese breadth is improving, giving opportunity to set up positions in places like Singapore, South Korea, Thailand, Japan small cap especially, very, very interesting. So developed markets ex-US acting very well, showing strong improving breadth. Commodities allocation is an opportunity there. We've seen them pick up over the last while. Emerging markets with strong US dollar. In light blue, that shows the virtual voiding of the EM on the strength in US dollar. I think the biggest issue right now and the biggest opportunity we've talked about a lot today is fixed income. And for those that need to be long fixed income, that's a problem. It's nice to be able to be short. We look at the last time rates in the 10-year bottomed in 1947 at 1.6%. We look at the returns for the next 10 years, negative returns for the US bond market. We're in reflation for the first time in 35 years. And people forget, where is it you make money in reflation? There's a bunch of sectors, and equities in particular. The turn up in rates in 1947 ultimately led to the Nifty 50 by 1972 trading at 60 to 80 times earnings. The tailwind was in dividend growth. So ultimately, I think we're at a really interesting time. We had a fixed income rollover in the summer of 2016. Clearly this chart looks worse as of this afternoon. Anything that is bond proxy related is broken. So now we're in an interesting time because we have the lowest correlations we've had in a long time, asset class to asset class, sector to sector. The lessons people have learned over the last 30 years will put them in the wrong spots today. Fixed income offers great short opportunities in developed markets and emerging markets. We can be anywhere. This portfolio changes dramatically over time. We believe we're in a structural bull market in developed market equities. And it's going to go on a lot longer than people think. When breadth models turn down, we get very defensive portfolio changes. But when we look at where the strength is today, financials, technology, materials, energy, some industrials, they're all reflationary assets. And on the other side, the assets that people have spent 35 years building piles of, bond proxies, that are very similar to some of the alternatives people think are the alternatives, long duration, low volatility assets, the tide is going out. So we publish our holdings in this portfolio weekly, pretty transparent and pretty clear what the structural themes are. Within each of these groups, there are subgroups that have cycles taking place that will go on well beyond the business cycle. So it's not just about finding areas of growth, it's finding areas of revaluation or spread or multiple compression to take advantage of on the short side. So we publish our thoughts regularly for those that are interested. And this is a strategy that we find people are using very specifically as something that is going to be quite different than the things they hold in their portfolio. It's 100% liquid, everything prices daily. It's a very simple, straightforward strategy, but I think one really well suited for this kind of environment. That's it. Any questions? Thank you.